Hi guys, it's Mosh. Welcome back to my channel. If you're new here, click on that subscribe button. If you want to see my daily trades, how much profit I make, the losses I make, news and updates, check out my Instagram page. I'll link it in the description below. Today, I'm going to talk about how to avoid big losses. And a lot of these are from personal experience. I have made some massive losses. I'll show you guys as well. And it was just from stupid mistakes I was making. My account would probably be 50% bigger if I didn't make these big losses. I'm sharing this with you guys so you don't make the same mistakes. It's all about managing your risk. I think one of the key things to understand is something called position sizing. Okay, so how does it work and what does it mean? Position sizing is the number of units a trader buys in stocks or either in Forex, in foreign exchange. Now, to work out position sizing, the first thing you need to understand is your account risk. How much of the total value of your account are you willing to lose? The general rule of thumb is about 2%. So let's say you had $1,000 or equivalent in your account. That means any single trade, the maximum you should lose is 2%. So 2% of $1,000 is going to be $20. So the maximum per trade you should be losing is $20. Now what that means for you is even if you lose 10 trades in a row, that means the maximum amount you have lost from your total account value is 20%, $200. This is very important, especially for beginners, because a lot of traders, they'll start getting some wins and they'll start making big losses and they'll blow your account. Blowing your account literally means wiping out the total value account. So if you initially put $1,000 in, you wiped out that whole $1,000 in stupid trades. Now, as you get more and more confident with trading and you understand the markets and how they work and certain instruments that you're specifically looking at, I would increase the risk. So for example, in my first video, and I'll link it in the description below, I don't risk 2%, I risk a lot higher. My risk generally is about 10%. And the reason is, I know people will be frowning and be like, oh my God, don't do it. But I have a valid reason. I don't trade with large amounts. And from the first video, I said only trade with what you're willing to lose. So even if my whole account gets wiped out, it just wiped out the profits I made from trading, and not even all the profits. I take it out and put that into my dividend investing portfolio. As a beginner, stick to the 2% rule. As you get more and more confident, increase the risk, because if you don't increase the risk, you're not making much. I mean, unless you're happy making like $10, $20, $30 each time per day, that's fine. But for me, I want to maximize the amount of profits. And as I say, the bigger the risk, the bigger the reward. Okay, so to understand position sizing, we looked at account risk. The next thing you need to look at is something called trade risk. Now, trade risk is to do with your stop loss. Stop loss is generally done in dollars. If you're doing Forex, it's done in pips. So you need to determine how many dollars when it moves down, you're going to exit from your entry price. So let's say, for example, Starbucks, let's have a round it up. Let's say it's trading at $75. I'm going to put a stop loss of $65. So that's around $10 per share. That is my trade risk. The next thing, once we've got account risk and trade risk, is proper position sizing. So it will determine how many shares you can buy. It's nice and easy to do. When we looked at account risk, we said we had $1,000 in our account. We're going to risk 2%. Which is $20. All you have to do is your account risk divided by your trade risk. So our $20 divided by $10, because we said Starbucks is at $75. If it gets to $65, that's when we're going to exit. So that gives us, if we do 20 divided by 10, 2 shares. That means from Starbucks, we can only buy 2 shares to maintain that 2% account risk that we said initially. So that's all you have to do. Account risk divided by trade risk. The next thing I want to talk about is something called gap risk. Even if you use proper position sizing, the market can gap. So what is a gap? A gap happens when there's been no trading and the price goes either up or goes down. It could be due to adverse news, a bad earnings report or a good earnings report. So generally it happens when the market closes, and when it reopens the next day, you'll see a difference in price, but there's been no trading. Let's say the stock has fallen below your stop loss price, your exit price. You're going to be stopped out at that initial open price when the market gaps. Now, to manage gap risk, generally the rule of thumb is you should half your position sizing. So whatever you work at position sizing, half that number, and that will manage your gap risk. The next thing is do not always trade. When I started trading, the biggest single mistake I made was trading literally every single minute of the day. As soon as I woke up, 8 in the morning to about 11 in the evening, I was trading every 5-10 minutes. It was crazy. I probably done about 2,000 plus trades in that single month when I started. And the reason is you get that adrenaline rush, if you're doing well, and if you're doing badly, you do revenge trading. You want to make that money back, and it is crazy. It'll drive you nuts. So don't do it. Only trade when your indicators tell you, or when you've done your research. If you're not sure how to work out indicators, I'll link in my technical analysis series in the description below. So go check that out. Now, the only benefit that came from trading every single minute for a 30-day period is I understood the market really well. I knew when the peaks would happen, when the drops would happen generally, and certain time frames when there's a lot of volatility. The next thing, create a trading plan. And in your trading plan, it should have all your research in there. If you're doing fundamental analysis of companies and you're not sure how to read financial statements, check out my financial statement series. I'll link in the description below. Use that, and whatever you put as your entry and exit price, stick to it as best as you can. Obviously, no one can predict the market. It can suddenly move in a different direction and you have to be reacting to that move. As long as everything is going to plan, stick to your trading plan. All right, there is a giveaway, a share up to £200 and the potential to win a Tesla share, which is worth about $1,500. All you have to do is create a free trade account and you could be in to win a free share worth up to £200 or a Tesla share, which is $1,500. Now, it does expire at the end of July and it is on a first come, first served basis. It only applies to one person. If you're watching this after July, you can still get a free share. If you create a trading 2-on-2 account, they'll give you a free share worth up to £100. And what you can do is create your account, get the share, sell it straight away, and it's essentially free money. I hope you like this video. Please like and subscribe, and I hope to see you in the next one.